E-commerce firm Jumia reported a 25% rise in revenues for the quarter ending in September. Well, management is confident that it will continue trimming losses and break even by the end of 2026. In the 9 months ending in September, the firm's revenues were up 5% to $127.5 million. The firm reported an 8% rise in operating losses at $52.6 million and a 37% drop in pre-tax losses to $50.4 million. Jumia's management is also forecasting pre-tax losses of $50.55 million for the year 2025 and $25 to $30 million for 2026. It estimates that the retailer will be profitable in 2027. Now, of course, after exiting South Africa and Tunisia in late 2024, Jumia has doubled down on its core markets. The number of quarterly active clients in Q3 rose by 17% to 2.4. There were more than 15.1 million goods ordered on the platform in the 9 months to September. That is 24% higher year on year. Meanwhile, the gross merchandise value for the 9 months rose 5% to $539.1 million. Meanwhile, over in Nigeria and Egypt, order volumes rose by 30% and 37% respectively. Well, Jumia is forecasting order growth rates of at least 25% this year, with a strong performance in the fourth quarter, of course, boosted by 4 weeks of Black November sales and the holiday season. Well, CGTN's Ramanyang explored that outlook with the firm's CEO, Francis Dufay. Let's take a listen.
We're not opening new markets in the short term. We believe that we have huge potential in the existing markets. Right, the current markets like Nigeria, Kenya, Egypt, Morocco, Ghana, and so on are still largely underpenetrated, even by our own standards, comparing with our best performing countries within the company. So we can do a lot more volumes. We can serve many more customers in those key markets to start with. And then the plan to get to profitability lies, of course, on strong top line growth, and we see that it's happening, right? Last quarter, we grew our volumes by 25% year over year on a like-for-like basis in hard currency, and also continued improvement of our efficiencies and cost management.
The number of quarterly active clients also went up by quite a bit, comparing Q3 25 to Q3 24, up by over 20% to about 2.4 million. But the other thing that stood out for me looking at your numbers is that 60% of your orders are now coming from outside the main urban areas in the countries you operate in, Nigeria, Ghana, Kenya, and so on and so forth. Is that going to be powering the next wave of growth and spending on Jumia platforms?
Well, that's not the only thing, but that's a very important strategic priority for us, right? We started from the realization several years back that unfortunately in our markets, on our continent, business leaders have a tendency to underestimate demand from smaller cities and from upcountry regions. And when we went underground, met customers, we realized there's demand and there's purchasing power in smaller towns as well. People have income from agriculture, farming, and a number of other small businesses, but they have nothing to buy, right? Local supply, the local retail network is usually pretty bad in those cities. So we've built the right logistics model so we can go and serve those customers out there with the same highly competitive, well-priced, good quality products that we have in the capital cities of Lagos, Dakar, Nairobi, or Cairo. It's going to continue, right? We're not at the end of this trend. So you see that the ratio of packages shipped to smaller towns is increasing every quarter.
I got the impression, just looking at the conversations you had on the analyst call after the results came out, I got the impression that the argument you also made to them was, look, our logistics expertise is essentially a sort of moat for Jumia, even though you've got, entrants like Shein and Temu coming into some of these markets, Nigeria, Kenya, and so on and so forth. But my reading of what you said was, look, our logistics expertise essentially is what will give us an edge vis-a-vis all of these entrants from outside the continent.
So Rama, I think it's definitely the right reading. Thank you. That's the right conclusion. We believe that we have deeply adapted the e-commerce business model to customers and vendors and partners in our markets across Africa. And this level of adaptation is actually very hard to replicate for any foreign company coming to, I don't know, Nigeria or Morocco or Kenya with a very standard, rigid playbook that worked at scale in Europe or in the US or in China, it's actually very hard to just copy-paste it to Uganda or Kenya. Very hard.
Walk us through the supply situation that you have at the moment, because you constantly spoke about improvements in the quality of supply, getting products from markets in Asia, for example, coming into markets here in Africa. And the impression I got is that we did have some supply chain issues 2 years ago, 3 years ago, but that has largely been sorted out now. Is that the correct reading of it?
Well, it's never fully sorted, right? I mean, supply is a topic of constant attention. We always aim to bring better products at better prices for our customers. What has happened, though, is that it's massively improved. First of all, the macroeconomic situation is helping us in a way. The currency stability is enabling importers to do their jobs, right, without taking too much risk. So there's a lot more supply on our marketplace. The recent pivot from Chinese manufacturers to new markets is putting Africa back on the map. So we don't have to fight that hard anymore. So we can get more supply, more products at better prices for our customers. And we really see that in the numbers. We see that the quality of the assortment is improving. The price points are better and better. The repurchase rate of our customers, the loyalty is increasing, and the satisfaction surveys are now at an all-time high. So we really see the impact across our whole platform.
When you say you're not having to fight as hard as you used to in the past, to convince these Chinese manufacturers to pay attention to markets, say in Africa, can you give us a bit more detail on that? What used to happen in the past?
Well, I think over the past 3 years, if you take just the past 3 years, first of all, there was a lot of currency volatility in key markets, Egypt, Kenya, Nigeria, Ghana, for example. And when that happens, international suppliers are a bit fearful, right? They don't want to commit large inventory to countries where there might be significant FX downgrade. They don't know how much money they will get 6 or 12 months later. So that's one. There was really a lot of suppliers being scared of shipping more goods to Africa and taking more foreign exchange risk. And second, Africa was seen as a relatively small and less attractive market. Now that things are becoming a bit more tighter with the US, we really see with our Chinese partners and international partners in general, a desire to diversify and to look at other markets as well. It's not just the US. And that gives a bit more attention to Africa. It's putting us back on the radar, and we're thus able to secure more supply for our customers.